In today's video, I'm going to go over all the do's and don'ts you must follow once you get pre-approved. My name is Duane. I'm a national wholesale lender and a certified government underwriter. Let's go ahead and get into it. Let's talk about why this matters first. And it matters because the pre-approval is a big step, but it's not a guarantee. Any changes in your financial situation can affect your pre-approval and your loan. But if you follow these key do's and don'ts, it will avoid delays and possibly a denial. So let's start with the do's. And the first one is to be financially stable. And that means keep making your rent or mortgage payment on time. So there are some programs where the lender is required to verify that you've been making your rent on time for the past 12 to 24 months. So if you're delinquent on that, then you may not even be able to get pre-approved. And if you fall behind during the process while you are in contract and the lender has to verify that you are still paying your rent, that could jeopardize your whole approval and your contract. And if you do have a current mortgage, then how can the lender feel good about lending to you should you be behind on your existing mortgage? And that soft credit check is ran, so they will know right before you get the keys on your new home if you've fallen behind on your current mortgage. And the next one is to continue to save. And that means that there are extra expenses that you're paying on top of your down payment and closing costs. And these are upfront costs like a home inspection or pest inspection. But let's say that when the home inspection comes back, that you decide you don't want to move forward. Well, you've already paid for that. And now you're moving on to the next property and you're going to get another home inspection. So you always want to continue to keep saving. Maintain current employment and income. So right before you get your keys, the lender does verify and reaches out to your employer to confirm that you are still working there. So if you get laid off or whatnot, then you 100% would not be able to move forward. But if you were working overtime and you got pre-approved working the overtime, and let's say it's taken you 90 days to get in contract, but you haven't been working overtime those past 90 days, well, the lender is going to want a recent pay stub. And if your income isn't the same, then that can jeopardize your pre-approval. The next one is going to be stay current on all debts. So obviously, if you fall behind on anything and the process takes a long time for you to get in the contract and a whole new credit report is needed, and you've fallen behind on debts, then that's going to lower your credit score. And anything that you're past due on must be brought current. You cannot move forward on any type of home financing with past due accounts. Now, the next due is going to be keep docs ready. And that means save updated pay stubs and bank statements. And that, again, just means that the process can be lengthy for you to get in contract once you get pre-approved. So new pay stubs and bank statements may be required. And that also means that you want to get back to your lender quickly should they need updated pay stubs and bank statements. Know that when you locate a home that you want to place an offer on, another individual probably is placing an offer on that same home. So you want to move quickly and be ahead of the next buyer, because essentially it is a competition when you are dealing with another individual wanting to purchase the same home that you want to purchase. And then you also want to notify your loan officer of any financial changes. And you want to do this if you can before the change. So if you feel like you're changing jobs or, your car broke down and now you have to get a new car, let them know that so that they can work on a plan B, plan C if possible. Now, the next do is to be credit smart. And that means to keep your credit balances low. So my recommendation on this is before you apply, to help make sure you get the highest credit score possible, your credit card balances are 20% or below. And once you have that pre-approval, don't use the credit cards again, because if a new credit report is required and your balances are up, then that means your credit scores are down. So I would suggest not to use the credit cards again until you get your keys. You also want to continue paying your credit accounts on time, and that was on the last due. So some of this is going to sound redundant, but this is credit smart, and it doesn't hurt to hear it again. So continue paying your credit accounts on time. Anything you fall behind on will have to be brought current, but that can also mean that your credit score is going to be lower. So maintain your credit. And you want to make sure to check your credit report for accuracy. So if there is anything on your credit report that's not correct, and you can get a copy of your credit report from the lender, or you can go to Experian, TransUnion, or Equifax. They give free credit reports actually if you've had your credit ran in the past 90 days, and their credit reports are pretty detailed and lengthy. But you want to review the credit report, but go over that with the loan officer, because some things that you do to your credit report, like putting accounts in dispute, you can't have disputed accounts when you're applying for a mortgage loan, because that removes it from your account and it doesn't reflect on the credit score. So before you do anything on making changes on your credit report, just consult with your loan officer for guidance. Before we move forward, if you are seeking to get pre-approved, I would love to assist. I've helped so many buyers that at the time when they did apply with me, they possibly couldn't get pre-approved. And I provided some guidance to them to help them get there. And actually, I've helped some individuals that I've been in contact for years, 1-2 years, but their ultimate goal was to be a homeowner. And we accomplished that goal together. They accepted my directions and steps to get them to the process of being a homeowner. So just reach out to me, scan that barcode, or go to my website. And we can also have the Zoom consultation and talk about your goals and what you need to do in order to be a homeowner. Now we're going to talk about the don'ts. And the first one is don't use credit. Avoid buying furniture, cars, or expensive items on credit. I unfortunately have had individuals do this, and 100% they ended up not getting the home, even with me telling them or advising them, not to do that. Some individuals may feel like, well, how will the lender know? And that's because they do that soft credit check. So just avoid buying furniture. And that's because large purchases can increase your debt to income ratio. And I do have a video that you can watch about debt to income ratios that explains what debts are included in your ratios. But you want to avoid the large purchases because they will lower the amount that you can get pre-approved for. So once you get pre-approved, avoid doing that. And especially before you get in contract, or even after you get in the contract, because if you do that, then your pre-approval amount is going to be lowered. And if you do it while you're in contract, your whole contract could be voided and you're out. And the next don't is don't change jobs or income. Avoid switching jobs or industries during the process. So this is a tough one, because if you feel like, hey, I'm going to get a new job, I'm getting paid more. Now, if you do that during the pre-approval process, then that's great, because you can possibly, well, not possibly, you will get pre-approved for a higher amount because you're getting more income. But if you do this during the process of you being in contract, it can be a little bit harder for the lender to confirm that you're working there, because you may not be in the HR system yet and whatnot. So the process can be a little bit tougher. You may need a new pay stub too. So my suggestion is to just wait. And that's just because any change in your job or income can impact your approval, and you don't want that to happen. And the next don't is don't apply for new credit. Avoid opening new credit cards or loans. And that's because each inquiry can lower your credit score 100%. And the process is lengthy. So any new inquiries are going to lower your credit score 100%. It's going to lower your credit score. So, and know that programs have required credit scores, but also interest rates are based on credit scores. So let's say that you were at a 720 credit score, right? But then it lowered to 715. The rate can change just from those 5 points. So if you want to make sure you get the best rate, then make sure that your credit score is higher. And again, new accounts may increase your debt obligations, which will lower the amount that you're pre-approved at. And the next don't is don't move money around. Large deposits or transfers can raise red flags. This is a tough one because individuals sometimes don't understand that all lending institutions are monitored by the Financial Crimes Enforcement Network. And this is a network who monitors large deposits, transfers, because they're looking for money laundering, fraud, or whatnot. So the red flags can be multiple types. It can be anything $10,000 up of a deposit that's not from your employer. Or it can be, let's say that you only earn $5,000 a month, but that direct deposit comes from your employer. But then on your bank statement, you have like 10 $2,000 deposits. That's a red flag. They're going to want to know where you got that deposit from. And again, it's monitored. So the lender is really following the guidelines that are set by the FinCEN. That's what they're called. So when they ask for trailing information, it's to make sure that there is no money laundering. It's legit funds that are coming from a legit source. So before you do any deposits or transfers, talk to your loan officer before moving funds between accounts. Just ask. It doesn't hurt to ask. A closed mouth doesn't get fed. You can jeopardize your loan if you don't source your deposits and transfers. Final tips: stay in touch. Keep your loan officer updated throughout the process. You always want to be ready with plan A and plan B, but that means that you need to be talking to your loan officer so they can figure out plan A, plan B, plan C. And also make sure that you're working with the loan officer that's answering your calls, answering your text, your emails, and is available. And that's just because that individual, that loan officer, is getting paid for your business. So they may as well be doing their job correctly. Also, ask the question before making the decision. Don't make the decision and then reach out and let them know, because they can't work on plan B and plan C if you're not letting them know ahead of time. Communication is key to a smooth closing, and that, again, is for all parties involved. Let your processor know, let your loan officer know, communicate throughout the entire process. It can only help you in the long run. There you have it, the do's and don'ts once you get pre-approved, and you want to follow these throughout until you get the keys. So important. And hey, if you feel like you have any questions and you'd like me to go over your situation and provide you some steps on what you can do to help make sure you don't jeopardize your pre-approval or to get pre-approved, go ahead and scan that barcode for a free 30-minute Zoom consultation. And please always like and subscribe if you feel like this information was useful, and I'll see you on the next video.